To today's webinar on the subject of hydrogen projects. Firstly, by way of introduction, I'm Jamie Logie. I'm head of Sullivan & Cromwell's Asia Pacific project finance practice based here in Hong Kong. I've been based in Hong Kong for about 5 years now. Before that, I was in our London office for nearly 20 years. And over this time, particularly in recent years, doing a lot of work in LNG projects, oil and gas, mining, power deals, and more recently, a lot of work on renewables. And today's topic, hydrogen. So I've been working on some hydrogen deals too, which is obviously great. Before John introduces himself, I have a scary message for US CLE purposes, which I'm being made to read. So pay attention, everyone looking for CLE points here. 2 CLE codes will be read during the program today. Please note both codes on the remote participant form provided in the link and submit them by using the instructions on the form. The next section's underlined, so pay particular attention to this. Partial credit is not available. So, good grief, I'm glad I'm not trying for CLE points here. Sounds very ominous. Anyway, John, why don't you introduce yourself?
Thanks, Jamie. Good afternoon, good morning, depending where you are. We're delighted you could join us to talk about hydrogen. We're very excited about hydrogen. I think it's a really interesting phase of development. It's a sort of unique situation, unique market. We see huge potential, and as Jamie said, we're already seeing engagements in the sector, which is very exciting. I've been a project development and finance lawyer for over 15 years now. Not quite as long as Jamie, but I am catching him up in the grey hair stakes. My experience spans LNG, pipelines, renewables, petrochemicals. So a lot of sectors with real relevance to how we think hydrogen projects are going to develop. So we've got a lot of slides to get through. So Jamie, take it away.
Sure. Thank you, John. Blonde John, not grey-haired. Okay, let's start with the first slide here. Okay, so by way of general background, first of all, lawyers don't usually have a chance to discuss subjects that can quite literally save the planet, but are also kind of cool. However, today on the subject of hydrogen, John and I are doing just that. First of all, a caveat: my mostly forgotten and ancient schoolboy chemistry makes me somewhat unqualified to discuss the science of hydrogen. Although today we will dabble a little bit amateurishly with the background techie stuff and the science, we want to focus on the legal, regulatory, and deal aspects of hydrogen as a game-changing fuel and commodity. You'll all no doubt have seen a lot of press and media coverage on the subject of hydrogen. So why are we getting all this excitement? Most critically, I think, hydrogen, when combusted, produces zero carbon emissions. This surely would cheer up even Greta Thunberg or dear old Prince Charles. This obviously fits well into global pressure for decarbonization, which is a very hot topic for next month's COP26 summit in my home city of Glasgow. As we will discuss today, use of hydrogen can help reduce emissions in various sectors, for example, transportation, agriculture, and heavy industry, more effectively than electrification. It can also provide a complementary energy store for wind and solar technologies, and these can be used for zero emissions hydrogen production, the production of what we call green hydrogen. It's also a great fit for the oil and gas industries, perhaps counterintuitively, which I think will have a key role to play in the transition of the energy sector. So moving on to the next slide. To put all this in a more macro context, the Paris Agreement on Climate Change commits 59 countries to achieving net zero emissions targets. This is also reflected in the private sector, where thousands of companies have made their own net zero target commitments. This is all happening quickly, and hydrogen looks set to be a key part of the mix. So when we discuss greenhouse gas or CHG emissions, it's important to remember that electricity generation accounts for only about a quarter of these globally, as you can see from the chart here. This highlights, for example, the emissions from industry, agriculture, and transportation. Hydrogen can play a key role in reducing emissions in all of these, as we will explore today. Now, not long ago, the orthodoxy was that renewable power was much more expensive to produce than using fossil fuels, and would remain so. However, with technical innovations, economies of scale, and the wonders of capitalism, which I'm a great believer, the cost of renewable energy has continued to drop, for example, by 13% over the last couple of years for onshore wind power, as illustrated here. So we'll explain later how this new cost environment fits with the hydrogen story. By way of more context, the transportation sector, remember that's responsible for 14% of global greenhouse gas emissions, remains stubbornly reliant on petrol, diesel, and fuel oil. Think in particular of the aviation, marine, and heavy truck industries, where electrical power really is nowhere so far. Of course, electrical passenger cars are becoming more common. I mean, look at the great progress in China, but the numbers are still way behind petrol and diesel. The car industry is forging ahead with EV and hybrid technology and making great progress. But query, could hydrogen end up as a preferred option? Could your EV end up as a Betamax tape of car technology? That's a reference for the much older viewer there. No one knows what Betamax tape is, John.
I remember Betamax tape, Jamie. Okay, so in this next section, I'm going to give a 10-minute overview, following which you will all be experts on the different types of hydrogen, the market size, both the existing market size and projections for what's going to happen to the market, and the applications for the hydrogen that is produced. Before I jump into that, and I'll leave that on a cliffhanger and read the first of the CLE codes. So please grab a pen if you're a US lawyer that needs.
Wake up, everyone.
This is the important moment. So the first code is 671539. That was 671539.
It's CLE bingo, John.
Okay, so the hydrogen production methods, first of all, you've probably heard a lot about the different colors of hydrogen, and I'll cover those on this slide. So the real excitement about hydrogen is as a low carbon fuel. And currently, hydrogen generally is being produced in a way that produces significant hydrogen emissions. It's either grey hydrogen, which is produced from natural gas, combining it with high temperature steam, process called steam methane reforming, or from coal, which is called brown hydrogen. But taking that existing process, if you capture the carbon that's being emitted, which can be done now with up to 95% efficiency, that becomes blue hydrogen, which is a low carbon fuel. There is some controversy around blue hydrogen and the effectiveness of carbon capture. I mean, personally, I think it's going to be critical to the transition, and bringing blue hydrogen into the mix is going to really help the development of the industry. But where I think there's most excitement is around green hydrogen, which is produced from the electrolysis of water. It's more energy intensive way of producing hydrogen than steam methane reforming. But when that's powered with renewable energy, it's zero emissions to produce. And then when it's combusted, that is also zero emissions. So that's it feels like a panacea for the world's carbon problems. There are various other types of hydrogen. You'll hear about various colors of hydrogen. The one that I'll mention now, pink hydrogen, is produced using the same method, but by electrolysis using nuclear power. That could also play an important role in those jurisdictions that are open to nuclear power. On the chart, you can see that the various prices or ranges of costs to produce these different types of hydrogen. And look, this varies significantly from project to project. There are trends in both directions. So gray and blue hydrogen, of course, both produced from natural gas and are sensitive to natural gas input prices. And we've seen those prices being very much on an upward trajectory recently. Whereas green hydrogen relies on the levelized cost of renewable energy and the cost of producing electrolyzers. That is very much on a downward trajectory at the moment. So I think we're going to see green hydrogen become much more competitive over time. I mean, another factor that's offsetting that higher price is that it is possible to achieve higher prices for green hydrogen and blue hydrogen than grey hydrogen. We are seeing price differentials emerge in the market. On exactly what is green hydrogen, I mean, on a basic level, it's hydrogen produced from renewable energy, but there is a little bit more to it than that. There's no sort of formal universal standard. The requirements continue to evolve. One of the hot topics is whether renewable energy has to be additional. So whether this is new renewable energy, it's not renewable energy that is being diverted, say, from the grid, which then leads to a need for additional power production, perhaps in the form of burning of fossil fuels. So the net overall impact isn't positive. Certainly the EU rules are looking at additionality of renewable energy. And there's a question for projects about how they design their projects to make sure they meet whatever the applicable regulatory standards are. And that is a bit of a moving target. So on the next slide, I mean, this is not new. Hydrogen is not new. The existing market is over $130 billion in 2020. But as you can see from the chart on the bottom right, the vast majority of that is high carbon hydrogen. So it's produced with natural gas or it's produced with coal. And in the conversion, moving away from those high carbon hydrogens to low carbon hydrogens, there's a ready market for either producing green hydrogen or retrofitting existing projects to convert them to blue hydrogen. I mean, very briefly on the next slide, you can see some of the projections on how the market's likely to increase. HSBC are predicting a 7-fold increase over the next 30 years. And this is just an estimate. It could be faster or slower, but huge numbers involved. The IEA are forecasting a 900 billion market by 2050. So moving on to the first of the drawbacks of hydrogen, which is that it is less energy dense. And by the time you've stored and delivered it to the end point of use, it's more expensive than other fuel sources. So to put it into context, liquid hydrogen, which has already been cooled and condensed into a small space, is 3.5 times less energy dense than diesel. It has half the energy density of liquid of LNG. Another way of thinking about it, if you took hydrogen at room temperature, the amount of gas required by a fuel cell vehicle to drive 100 kilometers would be 11 cubic meters. That clearly not practical for a car. People are getting around that in different ways. Car manufacturers, for example, are pressurizing hydrogen. That's the technology that's currently being used. And so one fill up can get your hydrogen fuel cell car 500 to 600 miles. But the lack of energy density is an issue. And so storage and transportation are both real challenges for hydrogen. And one option is to liquefy it, to cool it, and transport on very specialized ships. It could be transported through pipelines, but you would need substantial modifications to existing pipelines. Some blending is possible based on current infrastructure. And another really interesting method of transportation is conversion to ammonia, which we'll focus on a little bit because some of the projects, and the project that Jamie's going to talk about later, uses ammonia as a transportation method. So to cool hydrogen, to put it into liquid form, it has to be chilled down to minus 253. That's considerably colder than LNG, which needs to be chilled down to minus 160. But ammonia becomes liquid at 33 degrees or under 10 bar pressure. So it's much easier to cool ammonia to liquid form. Ammonia is more energy dense, although there is some energy loss in the conversion. Ammonia is toxic and can emit nitrogen dioxides when it's burned, but it's very well understood. There's existing infrastructure, existing storage, its handling and management are both very well understood. So to produce green ammonia, a project needs to have an ammonia loop. And that, based on the current technology, stopping and starting the ammonia loop is problematic. It can take about 2 weeks to get an ammonia loop back online after it's been shut down. And we all know renewables are intermittent. You need the sun to shine, you need the wind to blow to produce electricity, and to get a consistent power supply. So that could be a potential issue with ammonia loops. There are ways around that, and I think we'll see projects with battery storage, backup power, hydrogen storage, and turbines, but that all needs to be built into the process. As well as conversion back to hydrogen, ammonia itself has a number of uses. So it's used directly as fertilizer. That's the biggest use at present. It's a real focus as a fuel for shipping because ships are at sea for a really long time. Battery and liquefied hydrogen aren't really options for trips of that distance. So there's a focus on ammonia. Very interestingly, coal-fired power plants can be co-fired with ammonia with relatively little modification. So if you think of China, China has over 1,000 coal-fired power stations. If you co-fire even a fraction of those with ammonia, that's going to be a huge carbon saving. And just an example, JERA and IHI have announced a demonstration project doing just that, co-firing coal-fired power stations. So this is happening. This is real technology. So this chart I think this just demonstrates the versatility of hydrogen. Dr. Forrest of Fortescue described it as the miracle molecule recently, and I think we'd mirror some of those views. So very quickly on some of the current uses of hydrogen, it dovetails very well with renewables because of the intermittency of renewables. So it can be used for buffering, peaking. If the sun's not shining, you can use your hydrogen turbines. And again, the technology is really developing. So turbine manufacturers are developing 100% hydrogen-powered turbines. And Siemens, one of the very largest turbine manufacturers, has committed that all of its gas turbines will run on 100% hydrogen by 2030. So real progress. Just briefly to mention the HighFlex Power project. It's an industrial scale demonstration project, relatively small, but it's exciting that these projects are already being done. And this was funded under the Horizon 2020 European grant program. And I think that there are a number of grant and loan programs. We'll mention a few later, and I think they're going to be really important in the early stages. I won't try and pronounce the name of this fuel park in Korea, but another fascinating project, a fuel cell park. It's already operating, producing 59 megawatts through the stacking of fuel cells. On transportation, anyone with an electric car that tries to travel a long distance will tell you there are downsides to electric cars in terms of recharging them when you're trying to get a long distance. The time finding a charging station, the time taken to recharge. Fuel cells are potentially more efficient than batteries. Hyundai, just to pick one of the examples, has said that all of their cars will have fuel cell versions by 2028. So again, real concrete progress being made. It doesn't matter if you've got a hydrogen vehicle if there's nowhere to fill it up, but we're seeing interesting developments on that infrastructure side as well. Japan has said that by 2030 there will be 1,000 refueling stations already in place. So exciting times. This is a concept picture of a zero-emission commercial aircraft
that's very cool, John.
Yeah, a gratuitous use of the picture because it is so cool. One perhaps less obvious use of or potential use of hydrogen is in steel making, and steel production accounts for 10% of overall carbon emissions. Because steel is produced from heating iron ore with coking coal in a blast furnace. 10% is an astonishing amount, and steel making is very hard to decarbonise with other renewable energies. So this has great potential. A number of countries have initiatives in relation to green steel. There are demonstration plants already being built. I think that a lot of steel makers, that the costs are going to be very large, and the FT, there's an article in the FT today saying that the costs of renewable hydrogen would need to fall by 2/3 before this becomes sort of really viable for large scale. I think steel makers are probably hoping that there'll be government financial support for this transition. The cost of the sort of switch over for Europe alone is projected to be over $50 billion US dollars of investment. So big numbers, but incredible potential for a hard to decarbonize sector. And just I guess to wrap this up and how this is translating to real projects. According to a report from the Hydrogen Council with McKinsey, from just February to July this year, there were 131 new large-scale projects announced, which took the total number of projects to well over 300. The total projected investment into projects along the whole value chain is projected to be $500 billion by 2030. That's going to be a lot of investment, a lot of financing, and a lot of work for many of the people who've joined today. We chose interesting.
I should first of all apologies to all our hydrogen clients for the photograph here, but we really couldn't discuss hydrogen without at least a passing mention of the Hindenburg Zeppelin disaster, as illustrated here. But at least this highlights how much safer the technology is than it was in the golden age of luxury airship travel, as seen here. Also for extra educational credit, who can remember which album cover that photo is used on? This will date the audience. Okay, as rock fans will know, of course, it's Led Zeppelin's first album. Sorry, John, go ahead, that's a great photo.
That's amazing added value from the from the webinar, Jamie. So yeah, we described safety as slash safety perception, and I think that probably is more of a perception issue than a real safety issue. I think hydrogen is a relatively safe fuel, but the Hindenburg disaster obviously shattered public confidence and marked the end of the airship era, or the hydrogen airship era. A hydrogen disaster would obviously create similar issues for the market. We certainly don't think that's going to happen, but it's one potential barrier. As I mentioned, cost competitiveness, transportation, both challenges. There are concerns around the technology is perhaps a too strong a way of putting it, but the technology is developing. We'll talk more about that. The absence of a liquid market, we've got both the supply side and the demand side growing together. That requires a great deal of coordination and faith at both ends of the process. Infrastructure needs to develop for example, if you're going to pipe hydrogen around Europe, those pipes have got to be built. And finally, the speed of the regulatory process, and I think that segues us nicely onto the next section, Jamie, on the policy environment.
Sure, absolutely. So very much expanding on what John has just mentioned, looking at the overall policy environment and role of governments in this whole industry. Next, here we go. So really key to the adoption of hydrogen technologies, at least in the shorter term, is the development of government regulatory regimes which encourage and de-risk investments. Think of those various risks that John's just highlighted, in particular the entry costs. So the EU and governments in many major economies, including China and the USA, have announced hydrogen strategies in the last few years. Now, looking first of all at China, it's emerging as a potential leader in hydrogen with its net zero emissions by 2060 and 2030 peak carbon targets, and inclusion of hydrogen in the current 5-year plan. China's overall strategy focuses strongly on green hydrogen. China seems intent on other government support and has already made $20 billion of public funding available for hydrogen projects and $5 billion funding for fuel cell support programs. Various Chinese steel mills, going back to something John mentioned, are exploring use of hydrogen in steel making. As far as the EU is concerned, in 2020, the EU set out ambitious goals for the European hydrogen market, with a focus on electrolyzer capacity for green hydrogen production. Various EU bodies are earmarked to provide funding, with multi-billion euro investment being provided over 3 phases, culminating in potential large-scale investment, and this is in the scale of 120 to 130 billion euros, in a new gas grid infrastructure to transport hydrogen around Europe. Now, given the EU's current reliance on imported gas, this would be a real game changer. In July this year, the EU adopted proposals to reduce GHG emissions by at least 55% by 2030. This Renewable Energy Directive promotes the use of renewable hydrogen in various ways, including strict rules on what is required for hydrogen to be categorized as green. This goes back to something John mentioned also. Basically, green hydrogen being produced 100% from renewable energy, and note also the concern about additionality being a factor in this. Other interesting EU initiatives include support for infrastructure for refueling with hydrogen, with plans for filling stations every 150 kilometers in core road networks. There are also proposals related to the marine industries and various tax incentives. Looking beyond the EU, other hydrogen initiatives are being developed in Germany, Japan, South Korea, and Australia. Australia has announced a $300 million Australian fund in support of hydrogen technologies, and another fund for electrolyzer projects. With Australia's incredible solar and wind generation potential, which we'll touch on again later, Australia is well positioned to play a major role in green hydrogen production. Japan's also committed to achieve cost parity between hydrogen and LNG and gasoline, which is interesting for such a massive consumer of LNG for its power sector. Now, having said all this, it seems likely that significant additional government support will be needed to really turbocharge the hydrogen industry. This could extend to government-funded R&D, public-private partnerships or PPPs to de-risk investments, and public procurement initiatives, for example, for hydrogen buses and other public transport.
Okay, so we've talked about the 500 billion that's going to be needed by 2030. We better start talking about how some of that's going to be financed. Before we do, I will read the second CLE code. So I'll give people a moment to prepare. Whilst people find a pen, I'll apologize. There seems to be a slight delay between me changing the slides and them appearing on people's screens. So apologies that's not quite seamless.
It only adds to the excitement, John.
It builds the tension. So the second CLE code is 331540. That was 331540. And just to respond as well to one question that we've received through Zoom, we will circulate a soft copy of these slides after the session. So if anyone's not already received a soft copy, we will send one round. So just stepping back before we go into this section, what is bankability? Well, bankability is essentially how lenders will look at a project and whether lenders view a particular project as something that can be financed. Lenders, of course, don't benefit from equity upside from the projects they finance. They get typically the margin and their costs. And so they will not necessarily be prepared to take some of the risks that an equity participant would. Bankability is both an art and a science. It's holistic, it's deal specific, it's sector specific, it's country specific, depends on the lender group. So it's each project will be different, and there'll be an analysis of each project. Just because one hydrogen project is bankable, it doesn't necessarily mean that another or all hydrogen projects will be bankable. It will, of course, determine both the cost of funds for a project and the availability and capacity of finance. So this is really important for financing projects. Financing hydrogen projects is new. There are very few hydrogen projects. There's a couple that have either been financed or going through financing now, but this is really new. However, we're not building from the ground up. There are existing paradigms for project finance that hydrogen projects will build upon. In particular, LNG, natural gas, and renewables projects are all going to be important in informing risk analysis and the allocation of risk. And I think LNG projects in particular are going to be really important and provide a blueprint for some aspects of hydrogen financing. The similarities include the value chain. You've got the downstream, the midstream, the processing, the upstream, often shipping, new technology, marketing. There are very many very many similarities. And a lot of the players in the market, both at the banks, at the advisors, at the oil and gas company participants, at the utility and off-taker participants, have been and will be active in the market, in the LNG market. So I think that will be a blueprint. There are some really important differences. They include the players. You've got players in this market that you just never saw in LNG projects. You've got we'll talk about some of those later, but it is different. You've got the variability of renewables with an LNG plant. You know the throughput of the plant, you know the gas. Renewables, you're dependent on how much the sun shines, how much the wind blows. So there are some critical differences, but also some similarities that we'll be building upon. So talking about project-on-project risk and the value chain a little bit, just to give an example. So for a project, you may have a renewables plant or multiple renewables plants, if it's solar and wind, which I think is going to be common, and we'll talk more about that. Related infrastructure, so the transportation, the connections, probably battery storage in a lot of cases. You've got the electrolyzer. And electrolyzers are generally a sort of modular, which is helpful. You can sort of build out with electrolyzers. Electrolysis uses a lot of water. So for every ton of hydrogen that's produced, 10 tons of water get used. I think often these plants are going to be in dry locations where there's good solar resources in the Middle East, in parts of Australia, in parts of Africa. And so I think we'll see a lot of reverse osmosis plants bolted on. You've then got the transportation elements, which we've already talked about, potentially ammonia loops, and then ammonia to hydrogen cracking technology to convert it back. We've got storage, interconnection, infrastructure, shipping, and then the whole world of potential end users. So like this is a value chain that's going to be largely constructed from one end to another. So there's a lot involved there. So on how integrated projects are going to be, there are sort of two schools of thought here. The first is to bring as much as possible within the same umbrella, within the same project. And that allows sponsors to control all elements or multiple elements of a project. You could potentially have the electrolyzer or both renewables plants or multiple renewables plants all under the same EPC contract, which will really simplify risk allocation. The alternative is to sort of partition projects more. I think that's simpler. It's easier to see the risks that sit within a sort of siloed finance vehicle. The downside of that is that you've got, for most of these projects, initially at least, you're going to have upstream and downstream infrastructure constructed along with it. And lenders won't be prepared just to look at your sort of siloed box. So I think we will see a lot of integration, particularly in the sort of downstream processing levels, perhaps less upstream. For that project-on-project risk, I think we'll see structures to help lenders get comfortable with it. There'll be a diligence process, but there'll also be support and completion guarantees from financially strong developers are going to be important. That's obviously the LNG project paradigm. Government support, we've talked about already, that's going to be important. And potentially financially strong end users can assume some of these risks as well. Again, we've seen those sorts of structures for LNG projects. So the technology we're talking about here, it's not entirely new, but it will be scaled up certainly for the large scale projects that we're talking about. There are two types of electrolyzers. There's alkaline electrolyzers, which are cheaper, better established, the technology's more understood. And then there's the newer PEM, proton exchange membrane electrolyzers, which are newer technology. I think they're thought of as safer. They respond more rapidly. The FFI Fortescue plant that was recently announced, I think is going to be manufacturing PEM electrolyzers. So I think that's the way that the market is going to go. We expect sort of a lot of diligence around this initially. Once lenders get comfortable with a particular type of technology, there won't be a need to reinvent the wheel for every project. But in the early stages, I think where there is significant scale up or new technologies, there will need to be structures to help absorb that risk. That could be in the form of sponsor completion guarantees. It could potentially be in the form of performance guarantees and liquidated damages under EPC contracts. There could be guarantees under technology supply agreements. I mean, a lot depends. It'll vary project to project. It'll depend on the participants, their willingness and their ability to wrap those risks.
John, a lot of comparisons here with, for example, the early days of project financing for combined cycle gas power plants, right? It's very similar questions of risk allocation and ways of mitigating those risks. So it's a case of adapting deal structures to the new technology.
Absolutely, Jamie. So moving on to offtake. Offtake is obviously critical. It's the revenue stream. It's going to repay the lenders. It's going to produce the return on investment. And this is chicken and egg. There's supply and demand growing together. There's not really an existing spot market that may develop in key markets over time. But this isn't a commodity like oil or gold where there's a ready spot market. So we expect to see long-term offtake contracts. The market initially seems to be looking at contracts of tenors of 3 to 5 years, which won't really support project financing. Those tenors are too long. Lenders are likely to look at requirements similar to the early days of the LNG market. So the contracts in place for the full tenor of the debt with a tail. And as I mentioned, the renewables resources are going to be variable. They're going to go, they're not as consistent as for an LNG project. So that may lead to longer tails to address that concern. So I think the offtake question in essence is, who is the hydrogen going to be sold to and at what price? And I don't think those questions have really been answered from a bankability perspective yet. Projects have either been very small, or in the case of the big NEOM project in Saudi Arabia, which is currently going through a financing process, all of the offtake there is being backstopped by Air Products. And Air Products is credible in doing that because it's the largest global distributor of hydrogen. It has the expertise and the track record to do that. And I think Air Products is going to be targeting niche green hydrogen users and sees real first mover advantage. So if the Mayor of London wants to bring in green hydrogen powered buses, I think they're the kind of customers that Air Products are going to focus on, and have expectations of premium pricing for that as well. There's going to be an issue for early projects in that the cost of the technology is probably going to come down, and so offtake may be expensive in the early stage. But then we've seen similar things with, for example, offshore wind, where to start with there were the high subsidies, and those subsidies have gradually come down and down and down. to the point where in a lot of jurisdictions there is now no subsidy, and that's the kind of structural enhancement we may see. Government support certainly a possibility. It will be really interesting to see how this market develops. Project finance is flexible. We sort of, as a firm, pride ourselves on our innovative structuring, and I think we've moved the market for some of the LNG deals that we've done. So there will be fast developments in the area, I think. Very briefly on concerns under offtake contracts, and I think this will be similar to most types of offtake contracts. The really interesting elements for hydrogen are, I think, the potential to allocate green hydrogen regulatory risk. So we talked about additionality of resources being required in the EU. The offtake contracts may specify certain requirements or requirements to comply with a particular regulatory regime. Pricing is going to be very interesting. Green hydrogen obviously is a different market to grey hydrogen and blue hydrogen in that it's not gas price linked. I think we'll see this area evolve very quickly. There's potential for linkage to levelized cost of energy. There's the potential for sort of pass-through structures where the electrolyzer, that element of the project is on a sort of cost basis plus a return on equity, and pricing is done in that way. So a lot of factors. Price reopeners. How do you deal with the price reopener when the expectation is that the cost of producing green hydrogen will come down? Will you have price reopeners? Go ahead.
Sorry,
Jamie.
just to jumping in here, it's worth mentioning anecdotally that on a negotiation recently with an oil major involving a hydrogen project, someone from the oil company's trading division was talking about offtake contracts and marketing of hydrogen, and he, perhaps rather pessimistically, was saying that he doesn't think there will be a sort of fully mature, understood market until, or I'm not sure if he meant his or my grandchildren's generation, and he was much younger than me. So, you know, he saw it as a sort of really long-term market that's going to take a long time to develop. It's also worth mentioning, I think, that, you know, traditionally banks have liked to see marketing reports and experts' opinions on the market, and this will be, I think, a challenging one to get a sort of detailed longer-term prognosis on.
Yeah, thanks, Jamie. And I mean, the NEOM project is interesting in that the entire offtake is being backstopped by a sort of Air Products that is a specialist in this. I think we'll see more of those kind of structures as well.
I agree.
Sort of aggregation, traders.
Yeah.
Okay. So moving on. I mean, ultimately, the hope and expectation is that green hydrogen will stand alone without government support, but in the early stages, I think it's going to be really important. And there are already different types of government support emerging. We've seen similar for other renewables, and structures have been developed. In the US, we've seen tax partnership structures. In different jurisdictions, there have been different approaches to this. But that's likely to play an important role in the development of the industry, government subsidies, tax credits. So locating in a supportive forum will be important, but at the same time, the location of the project where there's the best sort of renewables resource, where it's close to market, is also going to be incredibly important, probably more important in the early stages. So there's going to be a balancing act there. These are essentially. Go ahead, Jamie.
Sorry, John. I'm just timing issue there. I see we have a question from a good friend in Moscow. Hi, Evgeny. Which is sort of fairly on topic with what we're discussing now. It might be worth taking a look at that as we discuss regulatory issues.
Sure.
Yeah.
Go ahead.
So Evgeny's question was mentioned that the success story with hydrogen is when individual national and EU initiatives on hydrogen are meant to succeed. Do you reject the very possibility of reaching an international public law framework to deal with the issue at hand? If not, what is the best platform to implement such international public law initiatives, UN, WTO, regional trade partnership agreements? Okay, that's an interesting question. I guess this goes to cross-border issues in the hydrogen industry and shipping and standards and just general treatment of the industry. I don't know. It's a great question, John. I don't know what you think, but I would have thought, looking at other industries, the likeliest path forward maybe treaties, regional trade agreements, and similar, rather than the big picture UN, WTO, global bodies getting involved. But I'm not sure. What do you think?
Yeah, I mean, there are a number of different sort of levels to this, and some of the existing investment treaties, for example, would apply to hydrogen projects. On a sort of more granular level around, sort of, for example, what is the definition of green hydrogen? I think we'll see standards emerge, and I think countries will sort of move towards adopting the same standards. But in other industries, for example, with solar and wind, we haven't really seen those sort of large scale global structures. It's been more on a sort of national basis or regional basis. So I suspect that's the way the market will go.
Maybe an obvious international components like shipping will need to be done by way of international treaties.
Yeah, and just to take the example of shipping, the one of the maritime sort of organisations has set targets for hydrogen adoption and sets rules on sort of decarbonisation. So that is happening in certain sectors, and for members of particular groups and organisations, it's not yet sort of happening on a more general level. But yeah, great question. Thank you, Evgeny. So yeah, and this sort of feeds into the last point I wanted to make on this slide, that regulation is changing and developing. We're seeing new things come out all the time in a broad range of jurisdictions, and that's going to make it challenging in some ways for people in the sector, because we're responding to a moving target, and people will need to sort of plan around that and how to optimize it. But we are still in the very early stages, I think, of the hydrogen market, or the green hydrogen, the blue hydrogen market, and this will develop over time. So the path forward for financing, I mean, initially I think we'll see a lot of smaller projects financed on balance sheet or with concessional loans and grants. The HighFlex Power project is a good example. That was funded under the Horizon scheme. The Yara and Engie project in Western Australia has received a $30 million grant from the Australian Renewable Energy Agency. And that's a small project, a 10 megawatt electrolyzer with photovoltaic panels and battery storage. So that's likely to be the way that I think most of the initial projects go. There'll be exceptions like NEOM, which I think is a $5 billion project. But generally, I think we'll see smaller balance sheet concessional projects. Project financing will be available for those projects that are able to sort of show a really strong story on all of the material elements. particularly offtake and market risk, probably with some structural enhancements, either sponsor support, government subsidies, wrapped EPC contracts. Financing will also become available early for sort of transportation network under PPP structures where the government is the contracting entity. That can certainly open up quickly. And another area I think we'll start to see very quick financings is for modifications to existing projects. So where grey hydrogen is being produced, it's got an offtake story, most of the capex has already been done, and there's sort of a bolt-on financing to turn it from a grey to a blue hydrogen project. For early, so the market will open up. I think it'll be in fits and starts. Lenders will probably want higher returns for earlier projects that they think of as riskier, which is again going to add to the cost of those early projects. There's a whole world of financiers that we think will participate in this sector. International financial institutions are likely to be sort of quasi-public or quasi-public entities are likely to play a really important role. They have policy goals beyond sort of pure commercial goals. Commercial banks, I think, will be keen participants, often benefiting from sort of guarantees from those financial institutions. Institutional investors will probably come along a little later in the process. We're seeing sort of pure play hydrogen funds being set up. There's a large pure play hydrogen fund managed by HY24, looking at managing some pretty large sums. It'll be interesting to see where exactly in the value chain they target their funds and investments. But ESG lending and responsible investments are incredibly hot, and there's a lot of money being committed. There's a lot of dry powder to invest, and there will be investments that go into these kinds of projects. It's just a question of how quickly the projects get to the stage where people are prepared to commit funding. The bond and private placement markets as well will open up for this. Probably not for greenfield projects, but certainly for sort of refinancings, potentially on a portfolio basis later on.
John, I think you've just answered a question from John Smelker in South Africa, who's asking what categories of lenders do you think can and will lead the debt on these financings in this innovative period? So I think you're in the middle of answering that question live.
That was good timing. Thanks, John. Great question. Hope you're well.
And good to know you're on, John. Hi.
To answer that a little further, the European Investment Bank is expected to play a key role. They've come out and said that they think public funds is going to be really important to the development of this industry. I think we'll see similar from the Asian Development Bank for Asia and the New Development Bank for the BRICS countries. So I think they will play a really important role. Just to take an example of an export credit agency, JBIC has listed new energy sources, including hydrogen, which was specifically mentioned as an area of focus. We're obviously not yet at a stage where we're seeing import-tied financings, but that will come, I think, as this process moves forward. We will probably also see export-tied financings. I think where electrolyzers are being bought from a particular country, the ECA in that country may finance the acquisition of those sort of goods and services. So that again accords with policy goals. So that brings us to a close on financing. Let us know in the Q&A if you have any questions. And Jamie.
Great. Okay, thank you, John. So looking now at M&A and joint ventures for hydrogen projects. As you can imagine, with ESG investments being so hot at the moment, as John mentioned, I've got the next slide up, John. So with the ESG investments being so hot at the moment, this is a really fast developing area. And we think M&A is only likely to increase as the market develops, with different considerations for investors in various stages of the value chain. So going back to John's observation, you may see rather than unified projects divided up into generation, transmission, electrolysis, shipping, transportation, marketing, and other components. Investors we're seeing in the industry range from oil and gas majors through to commodity trading companies, ESG investment funds, pension funds, and even family offices. Industry players like agricultural products companies with their ammonia expertise and automakers are also looking at opportunities. Different types of investors obviously have different interests, so coordination of these deal structures will be absolutely key. For example, an off-taker or hydrogen buyer taking an equity stake may, as John mentioned, be able to bring ECA funding to the deal in a way which has been tried and tested in the LNG and other energy deals we've worked on, including, for example, for Japanese, Chinese, and Korean off-takers. Financial, as opposed to industrial investors, such as green funds, may be interested in taking minority stakes, perhaps quite small minority stakes in projects, but may still seek a reasonable degree of control as a quid pro quo of investment with an eye on an eventual exit. Again, a fine balance is required to protect interests in such a new industry. Now, key to any joint venture structure is collaboration, both to share risk and to help ensure funding. And also, of course, to ensure access to know-how, technology, and project permitting. As I've mentioned, involvement of buyers and off-takers investors can bring real benefit, both for debt funding through ECAs, but also by providing security of sales and offtake, going back to the Saudi project that John mentioned. In the same way, construction contractors, technology providers, including hydrogen and ammonia experts, and oil and gas companies with their established trading platforms and expertise in large-scale project development can bring advantages to a new hydrogen project. Overall, our experience across other industries, including LNG, oil, and mining, is that bringing in parties with experience of developing, managing, and operating large-scale projects can bring real advantages to a project. In the same way, finding individuals for management roles with this important experience of large-scale projects is going to be vital. This is a limited universe, and partners who can help source key personnel will play an important role. Look at alternative JV structures. These can include vertically integrated ventures across the value chain, as we've discussed, from production all the way through to transportation and end users. Alternatively, and this can result from an analysis of tax, financing, permitting, and other issues, you can end up with multiple joint ventures covering different pieces of the value chain, and with important discussions on allocation of profits and careful consideration of potential tax issues around that. Transfer pricing issues, for example. As ever in M&A, the level and scope of due diligence for investors will vary depending on the nature of a project. However, given perceived first mover advantages in the market, investors, and in particular industry players, may be willing to take a more robust view of risk than lending banks. As John mentioned, lending banks are operating on a very different profit basis with a fixed return compared to the equity upside available to equity investors. Now, needless to say, the terms of investment are likely to be highly negotiated, and certainly that's our experience. As usual, the issues around leverage of parties and what they bring to the table will drive much of this. There'll be a balance between each sponsor's objectives, for example, strategic versus financial objectives, desire for control and operational roles. And their skills and resources, including technical expertise and softer skills like local relationships, maybe even with local communities and indigenous peoples, will be important to the mix and negotiations. Now let's move on to a little bit of a case study. So to put this in a real world context, we should mention Intercontinental Energy, or ICE as we know them, a very cool company, excuse the pun, and a client who've kept some of us in Hong Kong busy in recent years. ICE have been real pioneers in realizing the potential of aligning excellent locations for renewable projects. Basically, as John mentioned, sunny and windy, with a small local population with access to the sea for electrolysis to allow for shipping hydrogen, in the case of ICE in the form of ammonia. Current projects in development include the Asia Renewable Energy Hub in the Pilbara region of Western Australia, the Western Green Energy Hub in southern Western Australia, and another sizable project in Oman. These projects reflect ICE's strong relationship with local communities developed over the last few years. Now, ICE have focused on how best to complement wind and solar power generation to maximize system utilization, reduce costs, and of course, most efficiently generate the clean energy for production of 100% green hydrogen. Now, looking at these charts, you can see the advantages we've already alluded to in combining solar and wind in the sort of locations that ICE have access to. Looking back to the earlier slides we've discussed, ICE's projects are big, ranging from 25 gigawatts to 50 gigawatts plus, giving an edge in cost efficiency achieved through scale. In Australia, for example, this can achieve a lower cost per megawatt compared to alternative renewables and other power generation, as indicated in this chart here. Although ICE's business model is obviously new and exciting, the global move to low carbon hydrogen as a fuel source indicates that in future decades, projects of this kind under development will become very much the standard. The International Energy Agency, or IEA, projects that to meet demand, the annual growth rates in green and blue hydrogen will need to be 66% between now and 2030, and then 23% between 2030 and 2050. This reflects demand in areas including power generation, shipping, and aviation, as we've discussed today. On this basis, although when fully built out, ICE's projects will be significant, they'll still be only a relatively small component of this exciting new global industry. It's great to see Intercontinental Energy going from strength to strength as they develop these projects, and we're really happy to work with them as they do so. Now, by way of conclusion before we move into a Q&A session, as legal advisors, S&C have always been involved in first-of-kind projects and deals of a kind we're seeing in the early stages of the hydrogen market. As John mentioned, we find we're drawing on, but adapting carefully, our know-how from the LNG and infrastructure industries, and running hard to stay absolutely current in developments in hydrogen. The more we work with clients like ICE and others, the more we enhance our knowledge. Always happy to talk to players or would-be players in the market, even on an informal basis, to swap notes, ideas, and know-how. So we've covered a lot of ground today, and quite quickly, we'd be happy to circle back for one-on-one chats with anyone who wants to drill down a bit more in the detail. And just generally swapping notes at the moment is extremely useful for us, and we hope for our clients. Now, we're going to have a quick Q&A section here. Don't be too alarmed. Apparently, this is you won't be graded on any of this. This is a requirement of the Hong Kong Law Society for Hong Kong CPD purposes. So you never get to leave a training session in Hong Kong without a Q&A session, as John and I know. And we need our CPD points too, don't we, John?
We sure do, Jamie.
So John, do you want to lead us through the Q&A?
Sure. Yeah, as Jamie mentioned, these are for CPD purposes. If anyone has any other questions that you would like us to address, please feel free to put them into the Q&A box. I think we have a question that we will answer straight after these. So the first of the Q&A, what are the key bankability issues specific to financing greenfield hydrogen projects? I will give you a moment to think about that and then reveal. They are marketing and offtake risk, project on project risk, technology risk, transportation, and the regulatory regime. This, of course, by no means a complete and comprehensive list of bankability issues, but these are the ones that we think will be of particular focus in the early stages of the market.
Not in any order of preference either.
No, absolutely. So what types of investor are likely to participate in the early stages of the market? We see oil and gas companies, renewable energy companies, utilities, automakers, family offices, among others. Some of these people we don't see in sort of the project financings generally, and so it's going to be an interesting process for people to get up to speed on this. And finally, what are the factors driving the current development of the hydrogen market? People a moment to think about that. We see the factors driving it: net zero targets, demand for decarbonisation. Obviously, on the macro level, for hydrogen specifically, it does what electrification can't. It decarbonises hard to decarbonise areas. It's complementary to renewables. It's benefiting from cheaper renewables costs, and it's a good fit for market participants. So just on the final couple of slides, just to refer to you, hydrogen and renewables generally are an area that we are strategically really focusing on, and we're very excited about. So we've included just a few of our recent materials and publications, a few podcasts, webinars, and articles there for a bit of light reading for people. And I think we have a couple of questions. The first coming from a nearly frozen Moscow, asking, in the context of our experience, if from certain jurisdictions are applying extra diligence to financing not so green energy projects, do we see other not so sensitive players' appetite to fill the gap? I think the answer is it depends. There are projects that currently are struggling to find financing in the oil. I think coal-fired projects are probably close to unfinanceable in the bank market now. Jamie, do you have anything to add to that?
Yeah, I think that's right. It's some of the received wisdom about availability of financing is moving quite quickly now. So banks who previously were apparently interested in, for example, coal projects, seem to have backed away from those, and even the capital markets are nervous about coal, although for the right project there may be funding available. But even oil and gas is a sensitive subject, but relationship banks may be willing to step up. and the project bond market, the 144A capital markets may be available for the oil and gas industry, if not coal. And it may be that equity investments are more of a likely source for some of the less fashionable areas but still essential areas of the energy market. See, we got another question. What are you expecting the pricing of the debt to be? What the timing for reopener on offtakes will be, and which components you anticipate to be relevant? That's a lot to unpick there. Pricing, I guess I would say, depends on the overall risk analysis, ranging from extremely low pricing, where you have an investment grade offtaker for long-term offtake, particularly if there's bankable completion support, taking out the early stage technology risk, to comparatively higher pricing for where there's less certainty on offtake. John, any thoughts on that?
Yeah, I think it's going to be highly project dependent.
Absolutely.
It's going to depend on, as Jamie said, the risk profile, what supports there, the nature of the project. I think in the early days, the pricing on debt will be slightly higher than equivalent projects in other sectors, because this is new, it will be perceived as riskier. On the second part of the question on reopeners for offtake contracts and what components we anticipate to be relevant, I think it's too early to say. This is going to be negotiated on a case-by-case basis. We will probably see offtake contracts without reopeners, at least in the early stages, when that's necessary for projects to go ahead. It's going to be interesting to see how the market develops. On the components that might be relevant, I think the levelized cost of electricity will be relevant. As indices develop, they could be relevant for green hydrogen. Gas prices will be relevant, but I think it's really too early to get into detail on that at this stage. And one more question. How is the DoD looking at hydrogen? Is that not a faster way to develop this energy? I assume you're referring to the Department of Defense. Do let me know if you're thinking of something else. I mean, this is being used on a sort of local level, and there will be developments. But I think we're looking at industry as a whole, and big oil, big players in the market that are going to really drive.
It's a good point, though, that in a lot of new areas of technology, the defense sector turbocharges the development of the industry. So, for example, if sort of major navies start using hydrogen technology, that's likely to accelerate the know-how and the efficiency of the technology pretty quickly, in the same way historically that the aviation industries benefited from military aviation. So I guess it's a good point, and it could well be a faster way to develop the technology.
And another question. Thank you. It's great to be getting some questions through. could we list in order of market potential which off-takers will be first and foremost?
Great question.
It is a great question. I think Japan and Korea.
I think Japanese utilities and Korean utilities, right, were already future-proofing their gas power plants to be able to utilize hydrogen.
Yeah, absolutely. And we're already seeing those entities get involved in the market. They don't have great renewables potential. There's some offshore wind and smaller scale solar, but they really are dependent on importing fuel. They're already large scale importers of LNG. So I think those two markets will be really important. Third, I would probably put the EU, given the importance that is being placed on hydrogen and the level of regulatory and policy making enthusiasm for hydrogen.
EU utilities, right?
Already seeing EU, yes, EU
particularly if the infrastructure is developed, the transportation infrastructure developed the way they're planning. And maybe the UK too, since its current energy policy is so famously useless.
I forget we're no longer part of the EU. I try to put that out of my mind. And I mean, if we go back on one of the earlier slides, we had a list of the countries that have put in place hydrogen strategies and policies, and I think that is a good sort of way of identifying the countries that are going to be the prominent players in the early stages of the market.
I think in the more medium term that the shipping industry is also going to be a big off-taker and potential buyer of hydrogen, perhaps in the form of ammonia for bunkering.
Great. Feel free to type any further questions. Otherwise, I think we're coming to the end, and we can wrap up soon. So thanks everyone for joining. It's been a real pleasure talking about this. We're really excited about it. It would be great to hear from anyone that's looking at projects, wants to bounce ideas off us. We want, as Jamie mentioned earlier, we want to learn from you. We want to learn as much as we can about this industry, and to offer our knowledge and expertise as well.
Yeah, thanks everyone. Thanks for joining the call. There's always a fear that we'll be talking to each other and no one else, which isn't the case today. And we'd love to get dialogue going with all or any of you. So feel free to reach out to us. You know where we are, and we'll also circulate a soft copy of the deck, which you can read at your leisure. You might have follow-up questions based on that reading. So thanks everyone. Bye.
Thank you very much. Goodbye.
Bye.